the Democrats, and listen, I'm not picking sides here. My point is this: just when you thought the Democrats and their Build Back Better plan, the infrastructure bill, was going to provide some relief to commercial plan sponsors where the cost of prescription drugs is concerned, the rug was pulled from under you. And listen, I dig it. I prefer the government stay out of it because my position has always been education is the key. Education is the key to eliminating hidden cash flows to PBMs and generating more value through better patient outcomes. That's what we're here today about. So I'm going to be spending probably the next 30 minutes or so sharing some key insights with you. Listen, I pull no punches. I hold nothing back. I tell it like it is. I tell it how I see it. And from there, you will have an opportunity for Q&A or to build a relationship with me on LinkedIn. Let me tell you why you should. I've been in this industry now for almost 2 decades. And when I say industry, I'm referring to the pharmaceutical industry. I started out with Eli Lilly, a drug manufacturer. I was a pharmaceutical rep. That's how I broke into the business. And then eventually I worked my way into the corporate office, and I led a market access team where we were charged with negotiating, paying rebates to PBMs. This was back in 2002. Eventually, I left Eli Lilly. Always wanted to be an entrepreneur. And in 2005, I started a mail order pharmacy and been an entrepreneur ever since. Cashed out of that business in 2010, right when specialty drugs were taking off, in part because of my frustration with the low reimbursements coming back from PBMs, and then the kind of strong arming that you would get as an independent pharmacy from both generic drug manufacturers as well as wholesalers. I can remember the first time we dispensed a specialty drug, and it was a growth hormone, $10,000. Our cut, we were reimbursed $400. That didn't include, that wasn't net of the credit card fees we had to absorb when the members' cost share was paid by a credit card. So we were lucky to probably clear $300 on a $10,000 drug. I said, no, there has to be a better way. Cashed out, started Transparent RX, which at the time was the first fiduciary model to the truest sense of that standard of care in the business. And so it's in my best interest that whenever someone participates in a webinar or hear me speak, it's in my best interest to share everything that I know, because that's the only way to move from a non-fiduciary PBM business model to a fiduciary one. And I'm not necessarily speaking just in terms of Transparent RX. Our goal is to help you make better decisions wherever you may land, or your clients. If you have questions for me, there's a couple ways to get those questions to me. You can send them to me via chat, or you can raise your hand, at which point everyone's muted. I will unmute you and you will have the floor, and we can have a conversation, and everyone can chime in at that point. So 3 things. I want you to know how PBMs make money. Right? That's the very first thing I want you to know. Learn today, there can be no action that takes place And so the action that we want to have happen is understanding the problem. Price is a concern for self-funded employers. Right now, everyone is living high off the hog on manufacturer assistance programs, coupon assistance programs, uh, international procurement programs. Everyone's kind of living it's fool's gold. The savings that we're seeing today will be erased in 2 to 3 years because there will be more and more specialty utilizers who don't qualify for those programs or have absorbed the savings in those programs who are going to then hit the books. And so those plan sponsors will be back to pre-manufacturer assistance program cost levels in no time flat. So proper stewardship of the pharmacy benefit management never gets old. And so here's the problem as we see it: information asymmetry. Non-fiduciary PBMs intentionally make it difficult to determine how much money they are making. I'm going to get a little more into that towards the end of the webinar. So stick around here. But here's an example of information asymmetry. I told you, I call it how I see it. This is the director of compensation and benefits of a large health plan. Not a large employer, a large health plan who through their own broker cannot get access to their own claims data. The excuse, and it may even be a good one, but it's still an excuse. The excuse is it's proprietary. We don't want to give our competitors an advantage. That's BS. The truth is the PBM doesn't want this client to know how much money they are making. That's the first key insight. And to the point I made earlier, it is education which allows a buyer, a purchaser of PBM services, not to fall for this. And by the way, in this same conversation, this email I didn't receive until after our initial conversation had taken place. But during that conversation, this director of compensation and benefits says to me, they don't think education is going to help. Here's an example of what information symmetry looks like. A synonym for information asymmetry is information failure. This is information failure. This is here an example of information symmetry or information success. Believe it or not, most plan sponsors, when they receive rebate payments from their PBM, it's one lump sum. They may receive an invoice, one line item for one lump sum of dollars. But every claim that was eligible and eventually paid a rebate has an NDC associated with it. It has a claim number associated with it. It has a rebate amount associated with it. That's how you're able to determine net cost. Without knowing the rebate amount at the claim level, you can't determine net cost. You can't determine what part of it the PBM might be keeping. That's why many of them do not share this level of detail. But with education, you wouldn't settle for less. You wouldn't allow your clients to settle for less. It's hard to settle for not receiving this type of information when you know it is available. Why would you do that? And by the way, the information here, plan ID, RX number, NABP, National Association Boards of Pharmacy, uh, that information is provided in the reports that we provide to our clients. It's just redacted here for obvious reasons, privacy, right? So the status quo is this. A plan sponsor will enter into an agreement with a PBM that calls for an artificially too low administrative fee. The reason that it's artificially too low is because the PBMs, the non-fiduciary ones, really want to derive their revenue from the channels that you can't get a full accounting of. It's easy. If the administrative fee is per paid claim or a PEPM or a PMPM at the end of every month to see what that amounts to, what you're paying the PBM where an administrative fee is concerned. That's easy. The difficult part is accounting for spreads in ingredient costs and rebates. And when you enter into an agreement that calls for an artificially too low administrative fee, you unknowingly sign off on that blank check to allow the PBMs to generate their what? Their service fee, also referred to as their management fee, through hidden cash flow mechanisms. This source here is from PBMI. Here's a second source of essentially the same information. You see, it's tough in this business to convince people to trust you. So I like to provide multiple sources to back up the information that I'm sharing with you. Remember, and some of you may remember this, I do, because I was in the business at this time doing this exact thing. Back in the early 2000s, it was the small molecule brand drugs that was driving the PBM revenue, because generics really hadn't taken off yet. There were still some questions about generic drug efficacy back in the early 2000s, not today. And so when plan sponsors, when you got wind of this, got smart, this is called ballooning, where the PBM shifts costs from one area to another. And so when you got smart about this, remember mandatory mail order? You know, the independent pharmacies were up in arms, and plan participants were up in arms. You can't force us to go. And then okay, and then Medicare Part D said no, any willing provider, and state said no, any willing provider, and then PBMs ballooning. They shifted that cost again to what? Specialty drug rebates. They've already shifted the cost again. And so while this might be doing this, and it is, this area here is now going up, and it's called MBDCs, medical benefit drug claims. Both spreads, which can be gargantuan on the medical side, because there's not the oversight that there is on the pharmacy benefit side, even though the pharmacy benefit side has a lot of room for improvement in terms of reaching radically transparent levels. The medical benefit side, where prescription drugs are concerned, is even worse. It may sound like I'm bashing PBMs. I'm not. I believe we offer a very valuable service. I do. But my concern are the hidden cash flows to non-PBMs, fiduciary PBMs, that drive up the cost for health plan sponsors. I don't want to move forward without first kind of digging a little bit into the PBM business model. And I'm going to be focusing on everything to the right of this line here today. We contract with pharmacies, and I'm going to start with the contractual relationship. We contract with pharmacies to have sites from which prescriptions can be dispensed to our plan participants. Conflicts of interest may enter into the process when we own those pharmacies, whether they be chains, mail order, or specialty pharmacies. We have to have clients who provide these services too. They are third-party payers, self-funded employers, municipalities, unions, coalitions, state, federal government. Those are third-party payers, and then you've got the health plans as well. Now, we reimburse pharmacies. Now I'm touching on the financial flow, the flow of money. We reimburse pharmacies for the prescriptions that they dispense to our plan participants, and then we will bill our clients for the cost of those drugs. In other words, the ingredient cost. There's three problems here that I'm going to focus on. There's more, but let's just hit on three real quick. The first problem is here, the inflow of cash in the form of formulary rebates. It's too low. You saw two slides from two different sources, reliable sources, I might add, where 50% of the PBM's profit comes from where? The manufacturer. Why do manufacturers pay PBMs? Because we have influence on how many of their drugs get into the cabinets of patients. That's it. That's it. So if 50% of profits from manufacturers are staying with the PBMs, that means that the PBMs through arbitrage are not funneling back enough of those dollars to you or to your clients to do what? Get to lowest net cost. The second problem, we talked about the reimbursements to PBMs for the prescriptions that the pharmacies we contract with. That reimbursement is too high. That reimbursement is too high. And even in the infrastructure bill, even though now the government can now negotiate for lower drug prices, they left out removing the ability for PBMs to generate spreads. And listen, I want to be clear here. I want to be clear. Spreads aren't necessarily bad if the PBM is disclosing what they amount to. The problem I have is because the cash flows are hidden. I'm getting ahead of myself. I'm going to come back. And if the PBM discloses what they amount to and it's okay with you, the purchaser, that number. More on that here in a second. But the third problem, and it's kind of obvious here, Look who sits atop this entire system here. The purchasers, the government, the large employers, the medium-sized employers, the small employers, the unions. You sit atop of it, but know the least about how it works. That's why education is important. Mama always told me, boy, when you know better, you do better. The drug pricing standard, which forms the basis for discounted prices, is known as average wholesale price. It's a distraction. I'm not saying it's useless. I'm just saying it's a distraction. In this business, we refer to it as ain't what's paid. Generic drugs have two prices for the most part. All right, for the most part, AWP and MAC. There are some others, ASP and NADAC. And we can get into all that later. I'm going to touch on that. But for the most part, two prices. The AWP and the MAC. The MAC is more closely related to the actual acquisition cost. In other words, what it costs the pharmacy to put the product on the shelf. Then is AWP, but the MAC too is higher than the AAC. This is information I post on our blog. We post on our blog every Thursday, 99% of the time, every Thursday, and we update it, rotate drugs in and out. And we share the invoice cost, the WAC, and the AWP. This was old, but we have a more recent one up there. But this one's old. But I'm going to use this just to illustrate a point here. We talked about two price benchmarks, AWP and also MAC. Now, let's take a look at levothyroxine, 100 micrograms, 30 tablets. The AWP, let's call it 500 and let's call it 560. Keep it simple. AWP 561.85. Let's call it 560, just to make it simple. Now, here's why I say AWP can be a distraction. You go in, you negotiate with a PBM. They love negotiate from AWP, particularly the non-fiduciary PBMs. And they say, okay, we're going to agree on an 85% discount off of AWP. 85% of most anything is great. I wouldn't say great, good. 85% on your midterm exams, good. 85% of 560 is I'm gonna round this. Let's call it 475. So that's a $475 discount. That leaves a cost for levothyroxine of $85. Well, you're thinking not too bad. Average wholesale price, $560. I get a $475 discount. It's a distraction. The cost of this product for 30 tablets is $4. That's what it costs the pharmacy to put this product on the shelf. You still think 85% discount is good? So let's say the PBM is generous. It reimburses the pharmacy the cost of the product, the cost of the goods, $4, tax on 100% markup, and a $2 dispensing fee. The PBM's out of pocket is now $10. It keeps $75 as what? The spread. The spread. If a PBM is saying to you, we don't take advantage of spreads. There are no spreads. then okay, let me see what you reimburse the pharmacy. That's it. I'm not saying for every claim. I'm saying you should be able to go in and audit periodically if the PBM has said we're not taking advantage of spreads. What we reimburse the pharmacy is what we bill you. Fine. Let me verify that. And you should be able to see it in the contract. You don't need the PBM to tell you. It's in the contract. But it requires education to be able to see that, to interpret that. It will require a trained eye. Now, let's say that this product is on the PBM's MAC list. And let's say the PBM establishes, unlike AWP, where the price is established by the manufacturer, the list price. Remember, AWP is a lot like the sticker price on a car. Generic drugs are more like used cars. Brand drugs are more like Teslas in terms of the discount you're going to get off of that sticker price. So let's say that this product is on the PBM's MAC list. The PBM sets the price or the cost for that product because the MAC list is proprietary. No matter the source that we might use to establish what products are on our list, we ultimately determine what we're going to charge for them on that list. And so let's say the PBM here says that the product is going to be $15 on the MAC list. The out-of-pocket doesn't change. It's still $10. The PBM now keeps $5 for itself as the spread. I'm writing this with my mouse, by the way. So hang in there with me. I talked earlier about if a PBM says we're not generating revenue through spreads, and okay, fine, you're not. But to be able to verify that with 100% certainty, you need to be able to see the remittance forms, the 835 forms that the PBMs have to submit to pharmacies as sort of a receipt and explanation of payments for the reimbursements we give to them, we pay to them. The state of Ohio, this is about 2.5 years ago now, maybe 2 years ago, this report came out. It pivoted from a flawed evaluation process of a PBM's proposal or its performance. It pivoted. It said the state of Ohio said we're no longer going to allow the AWP and the discount we negotiate with you to distract us. We want to know what you're being paid. We want to know what you're being paid. Now think about this for a second. As a PBM, we bundle all of our clients' purchasing power and we take it to pharmacies and pharmacy networks and chains and independents, and we say, let's talk, let's negotiate. We do the same thing with manufacturers. Let's talk, let's negotiate. When a PBM knows that it is going to generate revenue for itself from rebates or spread pricing at the pharmacy level, who are they negotiating for? It should be you. It should be your client. But really, if 50% of the PBM's profit is coming from the manufacturer, the revenues or the rebates that should be flowing back to you. They are using your members' lives, your employees, as a bargaining chip to boost their own profits. That's what that is. It's not it's not creating value for you. They are using your employees, your members, as a bargaining chip for themselves when they're not transferring enough value back to you. The value is stopping at their banks. And so when the state of Ohio learned of this $250 million just in spreads, again, a spread is not a billing error, it is intentional. It is the difference between what a PBM bills its client and what it reimburses the pharmacy for the same prescription, the same claim. It's not an oversight, it's not a billing error, it is intentional. When the state of Ohio, in 1 year between these two PBMs, uncovered $250 million just in spreads, almost overnight, they terminated the contracts because they said in their minds it was unfair. It was too much money. That's all I'm saying to you. Disclose the cash flows. They should not be hidden. And then determine if it's reasonable to you. That's it. If you're unable to disclose the PBM's cash flows, how much it is going to make, walk away. Remember what I said. We're going and negotiating for you. We're going negotiating for you. What you ultimately pay is going to depend first and foremost on how much of that value we've negotiated we transfer back to you. There's too many mechanisms. The discounts, uh, off of AWP, and the number of drugs on the MAC list, and the different names and relabeling of rebate dollars, and the clinical programs, utilization management programs, and the international. There's the bottom line is, what part of the value we've negotiated are we transferring back? At the end of the day, that is what matters most. Misleading contract language, I've talked about that a little bit. I won't spend any more time on that other than to say, where MAC lists are concerned, uh, uh, there's multiple MAC lists, right? If the PBM is not pass through in the truest sense of the definition, not what you think it should mean, but what it actually means to the PBM. If the PBM isn't radically transparent or fiduciary in its standard of care, then it'll have multiple MAC lists. Some PBMs, if you ask them, will tell you they have upwards of 40 or 50 different MAC lists. Why? You know the answer. Again, I've talked about uh, manufacturer revenue, manufacturer derived revenue, in other words, rebates. And there's many names for rebates. And if the contract that a purchaser of PBM services has does not address any and all monies or revenue that a PBM receives from a manufacturer for, for any reason, not not about utilization, because some rebates are paid, they aren't based on utilization. They're based on market share, which is different. If the contract language doesn't address it, that's how the PBM gets to keep 50% or generates 50% of their profit from the manufacturer revenue. This is public information here, and I'm wrapping up here. Give me 5 minutes. This is public information. I'm just using this to illustrate a point. I'm not saying that this is absolute across all agreements with PBMs. I'm just using this to illustrate a point. It's a very good point. Formulary rebates between this PBM and this specialty drug maker are dwarfed by the administrative fee. This administrative fee is a manufacturer administrative fee. This is different than the administrative fee associated with being able to have claims processed and have an account manager and have a web portal and a mobile app. That administrative fee is different, completely different than this administrative fee. But to the untrained eye, they may believe when they see administrative fee in the contract, they're the same thing, and they're not. This administrative fee is essentially a rebate. Not essentially, it is. Price protection rebates, again, rebate. If X price goes up beyond a certain agreed upon threshold in a certain time frame, then the rebate that manufacturer owes to the rebate also goes up by a pre-negotiated rate. If it's not addressed in the contract, the PBM could be legally allowed to keep those dollars. And remember, we've talked about administrative fees, market share rebates, price protection rebates, formulary rebates. Depending upon the PBM, the name could be different in their contract than what we're sharing here today, but the reason they're being paid to the PBM is exactly the same. Outcomes rebates. This has been going on for a decade. And this is where we talk about value-based contracting and value-based reimbursements. If a drug doesn't reach an agreed upon data point, then it could be based upon the agreement between the PBM and that manufacturer. That PBM could be eligible for a refund. In other words, a rebate up to 100% of the original cost. Every PBM, every rebate aggregator today has these contracts between themselves and a manufacturer. Every single one of them. Because of the threat of PBMs being required by states, particularly states, to disclose rebate dollars and return 100%, not just rebates. Again, I want to go back to a more clear phrase, manufacturer revenue or manufacturer derived revenue. We talked about why manufacturers pay that to PBMs. Because of that threat, every major PBM now either has ownership in a minority stake or a majority stake in a rebate aggregator. And they're operating under a GPO, a group purchasing organization model, which means now instead of keeping manufacturer revenue through arbitrage, it could now just charge GPO management fees, just renaming the dollars. Just renaming the dollars. What did I say? Ballooning. When one area is cut off, you get smart, or there's legislation, the PBM shifts those costs somewhere else. Where rebates are concerned, they have shifted those costs to GPO management fees. And it could get worse because now there's an extra layer protecting the non-fiduciary PBM. So be mindful of that. A lot to take in here. So here's the bottom line. The bottom line is you have to start digging into, on a per client basis, on a per group basis, how much money is the PBM making off of us? I just don't know how you enter into a deal with the PBM where you don't at least know that. In 2022, how do you enter into a deal with a vendor? We're not talking about net profit. That's their business. And for many of them, it's public. But just gross revenue. What are you making off of us? I need to know whether or not it's fair. So what are they keeping in the bank on our group? That is important because undisclosed PBM management fees, this isn't this isn't fake money. This isn't fake money. The PBM's fees, what it keeps in its bank account, reside here in your final cost. They reside there in your final cost. To make matters worse, the CEO of CVS Health said this in a quarterly earnings call. And I'm talking about this here. This is out on the internet. In layman's terms, couldn't get past the third word, contracts. The third word in the sentence, contracts. Didn't say repricings, didn't say claims repricings, contracts. In layman's terms, he is saying, no matter what the sales folks are telling you, no matter what account management is telling you, I'm telling you, they have pricing analysts who have different marching orders than your account management team, than your client success team. And their marching orders are this: make as much money as you possibly can. We know that ultimately the amount of money that we're going to keep in our bank account is going to depend on how sophisticated or unsophisticated our clients are, period. The many levers available to pull, we just went through about 15 of those in this 40 minutes. We went through just about 15 of those levers in this 40 minutes. The CEO of CVS, the amount of money that he was referring to can be summed up in this formula here. We call it earnings after cash disbursements. We created this in-house. Everything in green, and you could even add in DIR fees here. You could even add in DIR fees over dispensing fees, or one and the same. They're different, but you can call it. Bottom line here, everything in green at some point lands in the PBM's bank account. A cash disbursement in red would be a reimbursement. Remember the business model we walked through, the United States Pharmacy Reimbursement Distribution System? The reimbursement to the pharmacy, that's cash out of the PBM's bank account. Your clients pay the PBM reimburses the pharmacy. If there's a difference, the PBM's keeping it because the PBM isn't going to overpay the pharmacy. You can count on that. That's a cash disbursement. Remember at the top of that same system, the rebates funneling back just the formulary to the plan sponsor, but keeping the manufacturer administrative fees, keeping the outcomes rebates, keeping the price protection rebates, passing back a share or a portion of those dollars is a cash disbursement. Whatever is left over is what the PBM is keeping for itself. I'm saying to you, no, not every PBM is going to offer a fiduciary model. What I'm saying to you is that there are PBMs that will, and there are others that at a minimum will offer radical transparency. Radical transparency means that you're going to be able to determine how much money the PBM is making off of your company, your plan, your group, your health system, your union, your coalition. If you can't determine how much money the PBM is making, there could be some transparency in there, but it's not the full extent. It's not 100% transparency. This client we brought on in January of 2020. When we brought them on, their PMPM was essentially $58. At the end of 2020, all in, net of our flat, now reasonable administrative fee of $7.95, I think we're charging them per paid claim. That's our only revenue source. That's it. The contract says so. Contract even says if we're making money any other way other than that, there's punitive damages that can then be charged to us legally. That's fiduciary. That says we're about you. Just pay us a fair fee for the service we're providing. The point I want to make here is this. Remember when I said the PBM's management fees reside in the plan's final cost for the year? All in through us, $23 PMPM. Don't believe me? I mean, listen, I'm not going to put this out there if it isn't true. I'm not going to put this out there if it isn't true. The point I'm making is this. Remember, I said the PBM's management fee or its service fee. In other words, what you're paying it to be the PBM resides in the plan's final cost. The genius of it all, it's not line item. It's not itemized. It's hidden in your plan costs. In this case here, Prime Therapeutics, which gets better rebates than we do, gets better negotiated discounts with the pharmacies than we do, was charging more than twice than what we were charging. You know why? Because their management fee, the difference between their PMPM and our PMPM is $35 PMPM. They were charging more to be the PBM than the freaking drugs cost in the first place. Let that sink in. People talk about providing transparency. When I say people, I'm talking about the PBMs. I'm talking about the brokers aligned with the PBMs. I'm talking about the PBM consultants aligned with those PBMs. People talk about they deliver transparency or they want transparency, but they don't want it at the cost of their own bottom lines. What about your bottom line? What about that? Listen, that's my time. We're about education. We're about eliminating hidden cash flows. And we start with education, whether it's with us, through another PBM. Bottom line is education is the key to eliminating hidden cash flows and delivering more value through your pharmacy benefit plan. We've got the first and only credential backed by a major university that helps you do just that. Go out online, do some research, check out the testimonials. The next class is January 2022. We're just getting started, and we want you to be a part of it. Eli Broad, my alma mater's business school, where I graduated from, Michigan State School of Business. Go green. I went through college not really knowing who this cat was the entire time. It wasn't until later I decided to pick up his autobiography. Come to find out, he's the only person to date, Elon Musk might be next, to be the founder of two different Fortune 500 companies. He might know a little bit about what he's talking about, since after or during his retirement, his philanthropical efforts were around improving healthcare and medicine, right? He believes education is key. Who am I to disagree with him? I know nothing about automobiles, but like everyone else, I occasionally need an automobile repaired. I go in knowing I'm overmatched. The only way I have a chance of not being taken, I believe, is sticking my chest out, acting like I know what I'm talking about. Inevitably, I'm going to decline services that I need and agree to services that I don't, if the repair shop I go to is looking for people like me. There are some who are going to do the right thing no matter how sophisticated you are about automobiles. There are others that won't. PBMs are no different. PBMs are no different. That's my time today. My contact information is here. I'm out on LinkedIn. We've got that CPBS class starting in January. Read what your peers have written about the course. People are saving money. People are getting promoted by participating in it. Why can't you? That's my time. Thank you.